Welcome to the Troy Kearns Podcast. We talk all things real estate, business, entrepreneurship, and today we're talking accounting with my good buddy, accountant, CPA, the guy who gives all my kids gifts for Hanukkah, Christmas, everything like that, Mark Sherman. Mark, you just spoke at our event. Welcome to the show.
Thank you. Good to be here.
Man, you look amazing, dude.
Thanks.
We used to work out together, and I know that weight is something that you and I kind of go up and down with, and you're really down right now. Tell me what's going on with that.
I found a way. I found a way to get there, to stay there and for a while. But yeah, it was just a health maintenance program, and I feel terrific. I'm no joint issues, no pain issues, and eating great food, and I feel terrific.
That's awesome. So, Mark, you're my CPA. You're a CPA. You're many people's CPA, and I want to get just right into it. We're not going to tell your story. If they want to do that, they can go back to the last podcast where we've had you on before. I want to go and just rapid fire ask you questions through this podcast. So, first of all, what is a 1031 exchange?
1031 exchange is where you can basically take a property you're selling, take the gain from that sale, and defer it into the next property, so you don't have to pay the tax currently.
Awesome. And how do you break it down? Like, when can I do one? How long do I have to hold the property? And can I buy one or two properties? Can I buy multiple properties? How does that work?
You can literally, you hold the property initially for a year and a day, then you can exchange it for another property that you're going to hold for an investment. You have to identify that property within 45 days, and then you have to close on the new property within 180 days from the date that you originally sold your replacement property or your relinquished property.
Right. So basically, I can sell my property, but do I have to use it like some sort of third party?
Yes, you have to use an intermediary. You can't touch the cash. You got to be able to have another company take possession of the cash from the original sale and hold it until you buy the new property, and then transfer that to title where the money will be used to buy that new property.
All right. What is a reverse 1031 exchange?
Okay, so reverse is like where you don't generally have enough time to do the 45-day identify on the property that you're going to sell, but you found the property that you want to buy, and you have the cash either to buy that property now, or you have ability to borrow money and buy that property now, and then you buy that, and then you do just the opposite. You have a 45-day window to sell your existing property and 180 days to close on that sale of that existing property. So it's just the opposite as a regular exchange. Exchange fees are different. They're usually higher, and not as many people do that, but it is available.
All right. So I have to sell my property within 45 days?
Correct.
Well, that's tough.
Yes, it is tough.
So
from the time that you acquire the new property.
Okay, so you could be doing them simultaneously.
Correct.
But you don't have to have the one. Okay, that seems like that has more of a gun to your head.
Yes, that's where the exchange fees, everything is more heightened, and again, most of the people don't do that because they don't typically have the funds. They need the funds from the property they're selling.
And just so you guys know, since we're such unlimited time, and Mark just got done speaking at our mastermind, and we will have that available on content later, and I'm just going to be rapid firing Mark questions because all of the answers that he knows, he's probably one of the best CPAs out there. And if you want your taxes done the right way, and where you want somebody that brings you value, someone that is going to like call you up and say, hey, guess what, Troy, I can get the IRS to write you checks for hundreds of thousands of dollars because the CARES Act includes all these little stipulations that say that you get that, then how can they follow you and get a hold of your company, and what's your company name?
Yeah, typically we have a director of new client relations, Tiffany Mitchell. If you call our office, 702-645-6318, or Team Mitchell at ShermanCPAs.com, you can reach her that way. And that's the best way to get introduced to our firm. She will give you all the breakdowns of everything in terms of how we can get you on board and help you with your needs.
Now, what about Instagram? Are you guys doing any of the socials?
She does do Instagram, and she does do social media.
What's your handle?
And she's more, I'm embarrassed to say I don't know.
All right, well, just do some Googling.
Yes. She's more familiar with that. I'm more old school, so she's more familiar with that. She probably could tell you everything.
Right. Can they email you directly?
Yeah, they can. They can email me at msherman@shermancpas.com. I have this time of year, we're incredibly busy.
Don't email them.
Yeah, don't email. It's better to email Tiffany, and she'll respond right away. Her response time just on Yelp is incredible. It's
awesome.
It's like an hour.
Hey, if you're listening to this podcast right now, I hope you enjoyed. I hope you give us a 5-star review. And we've got content all over the place, TikTok, Instagram, you name it. But we also have a coaching program. If you are looking for a coach, we have the Millionaire Mentorship, and this is a coaching program where I actually help you get your first investment property within the first 90 days, or I'll pay you $1,000 cash. That's how confident I am to get you that type of result. And I know you might be here and you might be listening, you might be scared, you might not want to take action, but that is not going to get you where you want to be. And obviously, if you're listening to this podcast right now, you want to take action and you're trying to gather the information, but maybe you're confused. Maybe you're just like a lot of people that I talk to. You're scared of losing money. You want to become financially free, but you don't know where to start. And that's exactly what I help you to do in this program. So do yourself a favor, book a call with me and my team, and let's get the ball rolling. The link is in the description, and we'll put it in the video right here, right now. Thanks. Hope you enjoy the show. Let's say I've got a business. It's not a real estate business. I've got a business, and I'm looking for some business expenses. What are some typical business expenses that I could do through like just traditional means? We won't go into S Corp, C Corp and all that stuff, but just things that I could do. Like what are some hacks? Like we could talk about the 14-day renting your house out. We could talk, I want to go through like all of the hacks that you would say. We obviously could talk about renting out the home office, but break down like, let's just go, what about the 14-day rule?
Yeah, basically you could rent your house out. What you're doing is you're basically having a 14-day period where you collect rent, but you're not paying tax on the money. That's basically what it is.
So break that down for me a little bit.
So in other words, you're taking this property and you're renting it out for business purposes, but you're not paying tax on the income.
But you're renting it to yourself.
Yes.
So you're renting that business.
So one side gets a deduction, the other side doesn't have any tax associated with the income.
Okay. If I have a business, and let's say I'm a landscaper or I'm a construction worker or I'm just a regular guy and I buy a 6,000-pound truck, how does that work?
Okay, so if you're in a business where you're generating income, self-employment income, and you use that vehicle 100% for business, you can take bonus depreciation in 2022 of up to 100% of the vehicle if it's 100% used for business. If it's in 2023, you can use up to 80% of that and take that right off. And that helps tremendously, especially if you're buying a vehicle for $50,000 to $100,000, then you have that write-off for that year against all of your other regular income.
What about my office? What if I have a home office?
Yeah, you can take a percentage of your home office, let's say mortgage, interest, property taxes, based on the square footage that you use exclusively for business divided by the total square footage of the house, and all the utilities, the insurance, repairs and maintenance, and then you take that portion times that percentage use, and you get that deduction in your business against that money.
Awesome. You are just a genius with this stuff. Okay, so I used to always think when people said, if you wanted to save money, start a business. And I didn't ever understand it, but now I do. Because by having a business, you have so many perks and benefits. Let's say I'm a freelance videographer, editor, and I have a business and I'm looking to figure out the least amount of way to pay taxes. And let's say, for instance, I'm just getting started and I don't have anything like going. Could I, if I'm renting my apartment, could I actually use that for business purposes?
You can use part of it because obviously you live in the house for part of it. But what's nice about that type of business, especially if it's on social media,
right?
There's a lot of different things. For example, you may acquire furniture that you use, but you use it to stage for your videos and stuff. A portion of that could be written off.
So your furniture could be written off?
Part of it, yes.
Right. What else?
Well, you've got the other thing is if you appear in these videos, your appearance is critical to what's going on in the videos and to your income associated with that. So there could be things, as far as like haircuts, gym memberships, different things that you do to keep up your appearance. If you have items that you normally wear that are uniform type items in the videos where it's just got the company logo, you don't normally wear it somewhere else, it could be deemed as uniform, and you could possibly take write-off for those. There's a lot of things. People end up also using, children in videos because they're part of what they're selling on social media. And it's possible that the children can be paid for their services associated with that.
Great answer.
Yeah.
So, Mark, let's say we talked about this question last time and it hit so well. I'm going to ask it again. Let's say I've got a business and I sell flies to guys, right? But it's not profitable, right? I'm just getting started. How could I write off my truck? Could I write off my advertising? Could I write off the flies that I make? Even if I make say $20 a month.
Yeah, the whole key with a business is there's two things IRS is looking at particularly is this really a business? Okay, so the key element to that is there intent to create a profit? Okay,
right.
Intent means revenue, gross revenue.
Right.
So are you generating some sales from the flies? Okay,
right.
If you don't, over a period of time, it's going to look like it's a hobby. It's not really generating anything. There's no intent to create a profit. But yes, you are. There's lots of businesses that for years don't make a profit, but they generate
Amazon.
Right. So they generate revenues, though. They generate revenues, so there's intent to create a profit. They just don't. They're not very good at it.
Right.
So yes, and those are deductible. The losses from those businesses are deductible. If they have other income from other sources, that's operating income. They could take that against those other businesses.
Having been a number of audits, and I know you've told me this before in the past, is you're only as good as your last audit, or check your CPA according to when he gets audited. What is the number one reason that people get audited?
A couple different things. One is they don't report all their income. That's usually one of them. The other one is the expenses relative to their income is out of control. And the funny part is they can be identified as far as what, for an audit. But if they have the support, we're not concerned about if their expenses are high. If they have the supporting documentation to take that deduction, then they should take that deduction. They shouldn't live on the life of audit lottery. In other words, I'm worried I'm going to get caught. I don't think I want to do this.
Right.
I want to do it. But if they actually incurred those expenses and they have the support, then we can provide that to the auditor, and they'll have to allow the deduction if it's ordinary and necessary in the course of that business.
What do you see changing with the IRS when it comes to like receipts and stuff like that? I know that they used to say, how long are you supposed to keep your receipts for?
Usually 7 years from data filing.
7 years from data filing. And do most people do that?
Some do, some don't. Some people keep it 3 years, some people keep it 7. But most people, they think it's okay not to keep the receipts. And the thing is, a lot of receipts fade over time. You're better off just scanning them and saving them in a computer file, taking a backup with a flash drive or another hard drive, because hard drive space is cheap. And that way you have proof, you have the evidence. And that's what the IRS wants to see is, hey, you have support for why you spent the money.
Right. So taking a picture of the receipt with my phone would be perfectly acceptable.
Correct. You would have the receipt saved on as like a PDF or something on a file and giving it to them. The key element with one type of receipt, like meals and entertainment, well, no longer entertainment, but meals, is that you want to be able to show the actual receipt where the meals are being paid for. In other words, showing the meals plus the tip and the total. And then you want to be able to indicate who you met with and the nature of the meeting. It doesn't have to be, it could just be, hey, met with Joe to discuss business. It doesn't have to be the detail of that meeting, just that you did that. IRS is interested, if you're going for a meal and it's $200, $300, $400, whatever dollars, they want to see it wasn't just you with a bottle of Dom Perignon and a hamburger, okay? They want to see that you were actually, taking someone out to try to cultivate business.
Okay, I've got a bunch of questions just jumping around in my head right now. The first one I'm going to ask is this whole giving pledge, right? Like, what's the scam behind that with all of these billionaires giving away their money and they keep getting richer and richer year after year?
Well, I mean, that's kind of a wide berth of information, but I would say...
From the accounting standpoint.
Yeah, so what's happened
like
is
Jeff Bezos, Bill Gates, all these guys, they
Right.
say, I'm giving away all my money, but you just keep getting richer year after year. Is that just them using like a connotation to sound good, and then they're using some counting principles to not really give away their money and to give it to their own organization?
Well, I won't say that flat out because I really don't know everybody's individual circumstance. But what I will say is that some people who want to give to others, I always found givers gain. Okay, so they're making money hand over fist in whatever they're doing, and they decide they want to give because they don't need to live on all that money. They give it to charity. They give it to other people who aren't as fortunate, and they have opportunities with the tax law to be able to take deductions based on the market value of whatever those things are that they're giving. So I think that that's a great opportunity for people who are wealthy to take advantage and help others that way. But there are organizations, correct, that where there's a lot donated to the organization, and because of administrative expenses, there's all kinds of salaries and other things that take away a lot of the funds that could be used to pay for for the charitable organization. In other words, why the organization got set up to begin with.
Okay, so kind of expanding on that, when we talk about nonprofit business, we see like the NFL was a nonprofit. We say that Rolex is a nonprofit. We see that all major hospitals that don't charge, $5 for aspirin, they charge like $500 for aspirins, are non-profit. What's the angle that you see as a CPA that these non-for-profit businesses are doing, like Rolex? I mean, we obviously know it's a for-profit business.
Yes. I mean, I think that I think at some point, of course, the IRS is going to look at something like that and say, you know what, that's not working, or they're going to challenge it. There's probably many of these organizations that, if they conduct themselves in that way, that where they're using the guise of nonprofit, that they're going to be audited more. They're going to be looked at and determine whether they're really following the guidelines of that organization's principles, what they're really supposed to be doing according to the tax law. But there are people, like I said, there are companies that really are nonprofit organizations, and they do give, to the less fortunate. So it's hard to say on any level who's doing that, who's not doing that. But yeah, here's what I would say. What the wealthy have as an advantage is they spend the money on professionals. The professionals can research the tax law and use the tax law to their advantage based on the way it's written. So it's not like they're doing anything illegal. They're doing things correctly. They're just using the tax laws that other people are not.
What have you seen in your career has been the biggest bite that the IRS has come? How scared should you be in business of the IRS?
You know what? The biggest thing is if you're doing things you shouldn't be doing, of course you're going to be scared.
Right.
But if you literally are spending this money in an ordinary, necessary manner for the business that you operate, you shouldn't be frightened about what you're spending because you literally have proof of what you spent. So there shouldn't be an issue. It's when people are spending stuff that they can't really legitimize the nature of why they're spending it on that. That's when they have problems. They don't have a story to tell associated with why they're spending the money on the business. Why is it a business expense? That's when they have issues, and that's when they're concerned. They get nervous about things. But I have a number of clients that they have expenses, and whatever they've incurred for business, they have the ability to support that. So they're not worried about whether the IRS is going to audit them or not audit them, because they understand the nature of, hey, they might be on the radar because of the fact that they earn a lot of income. And so they're going to be a possible target. So they just understand that, hey, we just have to be prepared. That's
right.
all.
So you've been investing in real estate for how long?
Probably about 14 years.
And in the last 10 years, you've really gone nuts, right?
Yeah, I mean, it's been a great opportunity, and in great part to you. I mean, if it wasn't for some of your ideas and advice, I mean, I might just still be just doing accounting, which
well, you were already doing it.
Yeah,
but you were looking at some of my returns and saying that, oh, those look pretty good. So, and you just recently bought a office building, like
Yes.
upgraded. You were in the same place for how many years?
It's actually, as of this month, it's 20 years.
20 years.
Yeah.
So why do so many successful businessmen and women buy real estate, and they call it a tax shelter. Can you explain how real estate can be a tax shelter?
Sure. Real estate has a few different things that you can use, one of which we mentioned at the beginning was a 1031 exchange where you defer the tax and you're not paying currently on the sale of a property. So now you're able to use that cash and buy other things with it. Another thing is depreciation. Depreciation is a paper deduction, and it gives you the ability to reduce the income that you've collected from tenants and not pay as much tax on the money. So that way, again, there's another avenue for you to be able to use it to buy other property. Real estate itself it can be a passive activity for many people, and they can generate positive cash flow, and they're not physically working for the money. So it gives them an opportunity to create wealth that they wouldn't have had otherwise.
Right. So if I'm going to expand a little bit more into that, when we get deep and we use because everything's vernacular, right? We're all like, real estate's vernacular, accounting's vernacular, and then you're trying to figure out what the hell's going on. Like,
right.
So when you used to explain things to me, I'm like, depreciation. Depreciation is code word for...
It's basically a deduction. It's a way
or
to
loss.
reduce. Yeah.
Like,
I mean, you could call it that, but it's really just it's another deduction, but yet it's not something you're physically laying out money for this moment. You bought a building, you spent the money on the building, now you're able to take a portion of it and deduct a portion of it over time.
So if I'm a regular homeowner right now and I have a house, I've got 27 and a half years of depreciation, which basically means like if the house was $500,000, I take away the land cost. Let's say the land cost is $100,000, and then I could take $400,000 divided by 27 and a half, and I got to take that much as a deduction against the income that I make. Correct?
Yes.
Now, how does that work for a real estate investor? Let's say I'm a real estate investor. I buy a skyscraper in downtown Kansas City. I buy it for $5.2 million. I put in, let's call it $10 million. How can I take advantage from a real estate standpoint, my ability to lessen my taxes?
Well, so for example, let's say that you decided, hey, on this building, I want to do what's called a cost segregation study. You could take that building and what would normally be a certain amount of depreciation, let's say it's $100,000 a year you get in depreciation. Now, because you're doing this cost segregation study, the building normally would be depreciated over 39 years. We can take a portion of that building and separate out into components that are depreciated over shorter lives. So you've got 15-year, you got 5-year, and imagine being able to take all this advanced depreciation up front while you're getting into the building and rehabbing it. And now instead of you can use that cash that you saved on your other income by not paying taxes on that other income and use it to do the rehab on your existing property or to buy other properties.
Now, can I take the improvements in the property? Would those count towards my...
Yes.
Okay, so
Yes,
if I
absolutely.
put more money in, I get to use that as my total... What is that called? Your cost basis?
Correct.
Okay, so it's based on your cost basis. So it would be my acquisition cost plus my amount of capital that I put into the property.
Correct.
Would be qualified for...
Yeah, the rehab, in other words.
Okay. So I did want to ask you a couple more questions. So let's say that I am getting interested in investing in real estate and I don't know which way I'm going to start, and I put the property in my personal name. What type of things does that expose me to?
Well, I'm not an attorney, but I could tell you from a legal standpoint that if you put it in your own personal name, then if there's if there's a problem with that property, like let's say somebody trips and falls or there's some environmental issue with that property, now they sue not just the property itself or the asset of the property, they sue everything related to you. Right. So it exposes you to a problem because real estate is essentially, it's a great way to generate income, but it's also can be deemed a dangerous asset. So you want to make sure that you protect it legally. So that way the biggest risk is just whatever you invest in that property is what's exposed and nothing else.
Awesome. So if I got an LLC, and can that LLC be a sole proprietor?
Yes.
Can that LLC be a general partnership?
Yes.
Can that LLC be what other things?
S Corp. And and just disregarded ownership of a rental property. In other words,
when you say
scheduling.
disregarded, you mean it doesn't have
It doesn't have its own tax return. In other words, it's disregarded for tax purposes. So that means everything. I'll give you an example. An operating business would report on what's called a Schedule C as a sole proprietorship on your personal return.
Right.
If you owned a rental property in a single member LLC, disregarded for tax purposes, you would report all of your income on what's called Schedule E on your personal return. That kind of thing. If it was a partnership, then you would report on a partnership tax return because you have two members that have different socials and have income flowing to both of their personal returns. So you have to have a separate tax return to delineate the income that comes from that partnership to the individual partners.
Wow. Okay. So in your opinion, what is the best LLC election status that you should take if you're a real estate investor?
You know, there's several different ones. If you're a real estate investor with another partner and you're doing real estate investing that's not flipping, then I would recommend a partnership structure for the LLC. If you're doing an operating business like property management or real estate sales or flipping, I would recommend an LLC taxed as an S corporation.
Okay.
That's to give you an idea.
Okay. And why taxed as an S corp?
Because in an S corporation, when you don't have an S corporation and you have an operating business, your income is also exposed to another tax called self-employment tax. That's Social Security and Medicare tax. And if you, right now, up to about $160,000 of net income from self-employment is exposed to this Social Security and Medicare tax if you are not in an S corp. If you're in an S corp, there is no self-employment tax. You're just required to pay yourself a reasonable wage for the services you're providing to the S corporation, and then the balance of the income from the S corp not subject to Social Security and Medicare tax. So you can save a lot of money, especially with
How much is that tax again?
15.3%. It's Social Security and Medicare tax.
Wow. Okay.
Yeah.
So what's going on with the Biden administration right now? Where do you see the state of affairs with taxes?
What I see, and even in future administrations, is when a presidential candidate runs for office, he has got a couple choices. Okay, he could try to say, hey, we should raise taxes, or he should say, hey, we could cut social programs. Well, the problem is you've got more than maybe 40-50% of the country on different social assistances, for example, Social Security, Medicare, welfare. So a presidential candidate is not going to advocate for, hey, let's cut social programs, because they won't get votes.
Right.
Then they're going to say, well, why don't we raise taxes? Well, nobody's excited about anybody raising taxes,
right, except
if they say raise taxes on the rich. Because then they think, oh, well, they should pay more because they're not paying anything, because there's too much media hype out there saying that rich people don't pay taxes. But the crazy part is rich people pay a majority of the taxes that are paid into the government. Okay, so ultimately what's going to happen, I think, in the future is you're going to see that the high tax bracket is going to go up. You're going to see more taxes assessed to wealthy people because that's the only avenue that politicians can have for getting elected.
Right.
And so that said, the more ways that you have of using tax loopholes or existing tax laws as you're making a lot of money to avoid some of this stuff, the better.
Why would I want to move to Puerto Rico?
Okay. There's a dynamic there. They have lower tax bracket, and you have to be careful because of residency issues and how you're conducting your business. There's a number of dynamics in.
But would I pay zero taxes if I lived in Puerto Rico?
It's possible.
So if I move, like, let's say I move my home, my family, my business to Puerto Rico, are there a lot of, why is Puerto Rico exempt from people paying taxes?
Puerto Rico wanted to attract more people to the country so that they could develop the country more. In other words, to contribute more into the country. But you have to, like I said, there's a lot of dynamics associated with that, with people that want to do that in terms of whether their business really operates there or it operates somewhere else, and where your residency is, whether you're really existing in Puerto Rico or you're not. I've seen a number of very high net worth individuals look to try to do that if they knew that they could operate and run their business from there. That's the key element, as many people can't do it because their businesses exist in the United States and operate in the United States.
So what do you think the best states to operate in are?
Well, there's 8 states that have no state income tax.
Which ones are they?
Let's see. There's
Florida,
Nevada, Texas, Alaska, South Dakota.
Comment below if you know the answer.
I know. I'm just, like I said, I was just thinking what they are. But the other thing is there's other states that have very low state income tax. To give you an example, Arizona just passed a law where their tax for 2023 is 2.5%.
Right.
Incredibly low.
And what's that based on, your total income?
Correct. But there's other states where you have no income tax on your earnings from wages or dividends or things like that. Like in New Hampshire, you have that, but you have a business tax. So you have to kind of know in what states you're going to have what taxes. There's some states that have low income tax but have high property tax.
But does it work the same way that the federal government does? If I have the losses, then I still can avoid the tax?
It depends on the law.
What about Missouri? You might know why I'm asking that.
Some states, no, most of them will follow the federal law to some extent, but they have some exceptions as far as different things you can deduct, not deduct.
Right.
But that's I'll give an example. Like in California, they have a clawback law with regard to 1031 exchanges, where literally if you sell a property later, that same property you 1031'd, and you sell it for cash, you have to go back and pay the tax to California, even though you did a 1031 exchange in year one.
What? Take that to go backwards on that?
Yeah, they have what's called a clawback rule. Let's say that you buy a property and you held it for a year and a day, and you decided you made a lot of money, but you want to sell it and not pay tax, so you do a 1031 exchange. Right. Then when you do the 1031 exchange, and let's say the property was in California, then you go into another property, but then later that other property you go into, you decide you're going to keep the cash at that point. When you keep the cash, you have to literally pay California back for the tax that you would have paid on the 1031 exchange.
But I 1031 exchange into another property. I'm not following.
So the federal allows you to continue to kick the can down the road if you keep doing 1031s. But if you don't do a 1031, I'm saying then on the second property, then what would happen is the state of California wants their money from the original sale.
Okay, but it would only be federal normally is what you're saying, and California is saying, I want some too.
Right, in the future, exactly.
Because normally you wouldn't be having to deal with that with the state.
Yeah, unless you bought back again in that state. But if you didn't and you're out of that state, they wouldn't have anything to do with it. But if you're in that state, you would still have it, but except for California, where you have to pay that back.
Okay.
And there's a special
California
form.
A good tax haven?
No. No, unfortunately, that's among probably 2 or 3. New York, New Jersey, and in California are one of the highest in terms of income tax.
Cool. So what tidbits would you give for people who are starting out in business and they're listening to this right now and they're like, okay, man, that's a lot of information. I mean, I know just trying to keep up with you, it's crazy. You know so much information. What tidbits of information would you give our listening audience?
I would say the first thing is, you're probably really good at what you do. You're good at being the technician in the industry that you're in. When it comes to tax and accounting and things like that are going to affect your livelihood and what you have to pay, I would recommend you get with a professional and get advice from them, because for the very little money you're going to pay for that associated with the large amount of good advice and tax savings, it's well worth it.
So hire you.
Yes, I would say you could hire me.
Yeah, and I would second that notion. Man, I really appreciate coming to the event today. Are you staying for the rest of the day?
I actually have to go because I'm up against it. It's our second busiest time of the year.
So you're going back to the office?
Yeah.
That's exactly why you need to hire Mark Sherman to be your CPA. I mean, he's been a good friend. He's been a good ally. He's saved me hundreds of thousands of millions of dollars probably at this point in time in tax savings. One final question. What laws like the CARES Act why do they stick these little things in there for these people?
Well,
and what did they stick in the CARES Act that helped out a lot of investors?
There's a number of different laws. They have PPP loans. They had the employee retention credit. They had ability to carry losses back in 2018, 19, 20, 5 years to years where you had income, where they had changed the law before. There's a number of different things. They had these funds that they gave out to people, so there were so many different things that happened because of the fact that businesses were really hurting from COVID. And another one was having meals and entertainment be 100% deductible for 2 years running, where normally it would have been 50% deductible.
Right.
So they wanted to encourage people to go back to restaurants and spend money where they didn't have before. So there's a number of those things that have helped businesses quite a bit to bridge the gap for income they lost during the pandemic.
Awesome, man. If you guys want to get a hold of the best accountant in all of the world, my recommendation is you get a hold of Mark Sherman in Las Vegas. And no matter where I'm moving, I'm sticking with him. I've referred every client to him, and he is a tremendous amount of information. I just wanted to go rapid fire because we just had a little bit of time to do our podcast. I appreciate you coming on the show. I appreciate you coming to the event, and I hope we continue to know each other for a very, very long time, man.
Likewise. Thank you for the opportunity.
Peace. So I wanted to interrupt you in this podcast and just take a quick moment to tell you two things. Number one, we do this for free for you. I haven't made a nickel on social media at all. I'm doing this to provide you enough value, so all I'm asking for you to do is share it and give us a 5-star review. It'll totally help us out, and I really appreciate it. The other thing, if you want more free resources like our free Facebook group, it's Millionaire Mentorship Real Estate Investing on Facebook. All you got to do is join it. It's free. It doesn't cost anything, and there's lots of resources there, and we'll definitely give you those for free, no charge. Here's the other thing. If you're serious about investing in real estate and you're ready to take action, I have a program. No matter where you're at in your real estate journey, I can help you out. I don't care if you've got 5 houses, 10 houses, no houses, 100 houses. I've got something that I can share with you that's going to make you a lot of money. And if you want to become financially free and you're brand new to real estate investing, this is the absolute thing you want to do. And here's the thing. What I've learned from most of my students right now is that it's not just an investing program. It's a mindset program. We're going to change the way you think about money. If you want to start investing, make sure you schedule a call with me and my team, and let's get the ball rolling. Guess what else? If you are like, man, I don't got the time and I make tons of money, I just enjoy listening to what you're going to say, that's cool too. We actually have set up a fund where you can invest with us, but you got to be an accredited investor. If you want to find out what that looks like, all you got to do is click the link in my bio, fill out the form. It takes you about 2 seconds, and then we'll let you know about the deals that we're doing. We're doing big deals in Kansas City. And this year, I think we'll do 2 huge deals in Kansas City. I'm looking at a few right now, and I want you to be a part of it. And if you've got more money than time, then that's what you should do. If you got more time than money, then schedule a call with me and my team, and we'll get you into our coaching program so that you can have more money than time.